Welcome to the December 2023 monthly motor checkup. My name is Dave Lundgren, and I'm the Chief Market Strategist and Portfolio Manager here at Motor Capital Management and Research. The name of the video this month is Put Down Your Axe and Enjoy the Fire. Before we get started, let's take a look at the disclosures quickly. Okay, put down your axe and enjoy the fire. One of the concepts that I talk a lot about is this idea that bear markets or consolidations, but bear markets in particular, are like chopping wood. It's hard work, it's dangerous, blisters are to be expected, and if you're not careful, you might even hurt yourself. But however, the byproduct of all that work is that you have a large pile of wood. And of course, the longer the bear market, the bigger the pile of wood. And of course, the bigger the pile of wood, the bigger the fire, or in this case, bull market, and the longer it will last. So from my perspective, price action since the October lows suggests to me that the fire has started. And after chopping wood for 2 years, the bull market may last longer than most expect. The idea is that I've been investing for 30 years and I've navigated through a number of bear market bottoms, and I can say probably without exception, at the turn, it wasn't particularly clear to me what the macro driver was that was going to light the fire, if you will. But nonetheless, bull markets happened with or without my blessing, and they have since the beginning of time. So I don't need to understand it today in order for a bull market to start. So, from my perspective, when the fire ignites, I don't ask questions. I just simply adjust the portfolio, making sure that I own the right things in terms of leadership, and then we'll find out why later. As it stands today, and it has stood for quite some time now, the leadership remains very cyclical, with tech, industrials, and consumer at the top in the top spots, and some financials and materials dominating the leaderboard as well. So very cyclical and plenty to choose from. And then, of course, as promised in today's earlier charting my interruption, I promised I would address what I think is going on with Disney. I think there might be an opportunity here. Okay, so I've been for a couple of, well, actually probably about a year now, I've been really harping on this idea of the importance of the value line geometric average. And it might be to the point of where it's getting annoying or maybe even obnoxious. I speak about it so much, but I want this chart I featured in last month's video, and I just want to re-demonstrate why what the average stock is doing is so important. And it's simply because if you look at the popular S&P 500, the index is cap weighted, and you just don't have bull markets of sustainable force without the average stock moving in the same direction. They just think about this as being the breadth of the market. There are many ways to measure breadth. I happen to think that this is the best way to measure breadth. I would not say that the value line average is a good way to represent the degree to which wealth is being created in the country. I think that's what cap-weighted averages are for. But in terms of measuring the breadth of the market, I don't think that there's a better way to do, or at least certainly not a more simple way to do it than just simply monitoring the value line geometric average. And so you can see that when these two move together, you have powerful bull markets. When they don't move together, you have at best sideways markets, if not bear markets or the beginnings of bear markets. And so what we've clearly had since the end of 2021, early 2022, and in particular since the October bottom, is a highly divergent market. It doesn't necessarily mean it's going to end badly, but it is what it is. And what it does suggest is that unless and until this resolves, we are not going to have a robust bull market. So something to keep in mind, and it's why I speak about it so often. So this is another slide that I highlighted last month, and I was just simply talking about the setup is in place for the market to rally across the range because we were so oversold, still at support. And so the idea was that was the time to do your buying and cover any short exposure that you had on the idea that we were going to make our way back across the range. And what was important on that rally and what we would be monitoring for in that then coming month would be whether or not we were able to get any kind of or significant enough trend change and strong enough momentum in order to inflect the trend structure of the market to the point where it became a good overbought. unlike this overbought condition, which was just didn't have the momentum in the trend structure behind it to sustain it. And of course, we ended up at the bottom of the range again. And last month, we were open to the idea that we could fail here again. We didn't know, but the idea was that we could get there, and then let's just see what it looks like when we get there. And so when we look at what's changed since then, this is where we really see a difference between this rally and what happened over the summer. So this is a snapshot of what it looked like at the time of last month's video, and you can see that there was a minority of charts were in uptrends in the long-term and medium-term timeframes. Remember, the long-term chart is the quarterly chart. The medium-term chart is the monthly chart. In the short-term chart, just remember this is the weekly chart. So again, the weekly chart for most technicians is the long-term chart, but where I'm trying to really make sure my trend analysis is engaged and rooted in fundamentals, my short-term chart is the weekly chart. It's not that it's good or bad, or it's just simply different, and I just want to make sure that I point it out so that you remember when you hear me say short-term, I'm not talking about 15-minute charts and hourly charts. I'm talking about the weekly chart. But this is where we were at the beginning, or I should say at the time of the last video, and the biggest trend bucket in both timeframes was downtrend. So 25% of the 2,600 stocks in the motor universe were in a clear downtrend, trends making new lows, and 34% were in a clear downtrend with trends making new lows in the medium-term time frame. Now, what was good about that setup, and that suggested that we could get to the top of the range, is that right out of the gate we had 60% of the market had a positive trend on that weekly chart, which again is a significant chart, and 83% was showing positive momentum. So that's a good momentum burst off of that low, and that kind of clued us into the idea that we could get back to the range again. And also quite positive was that half the market was in an actual clear uptrend, a trend making higher highs in that weekly time frame. So a great place or a great foundation to really set the stage for a rally to the top of the range. And of course, we've been talking about this quite a lot as well, and that is that when you break the trend stage down by market cap, of course the vast majority of the market cap is in an uptrend, but the biggest trend buckets are quite constructive from a market cap perspective. So again, just another positive to point to with respect to how the market looked while we wrote last month's video. This trend stage is one of the 5 key elements that goes into this risk gauge. And at the time of the video, this was also relatively constructive. We had both the long-term and medium-term, again, quarterly and monthly risk gauges were pretty mixed. And this is after the worst bond bear market in history, and banking crises and geopolitics and political issues and whatnot. The market just is more calm than anything. It's not really rattled by anything. It's not excited by anything. It's just in a range, and that's well depicted by our risk gauges here, sitting here at 6. That's how we were at the time we did last month's video. And on that early surge off the bottom there, we had the risk gauge on the short term, again, weekly time frame at 4, so just one step below risk on. So this had the potential to be a trend changing move for a change. At the time, only 36% of the stocks had a rising 200-day moving average, and of course, by definition, you cannot have a sustained bull market unless those 200-day moving averages start to rise. So the fact that only 36% of them were rising at the time was obviously not positive, but at least gave us a measurement that we can compare 1 month later and see how it looks. So here's how we look as of now, and we can see it's quite a bit better. We have green almost across every box here in the time frames. The only slight red here is positive trend in the quarterly time frame, just missing it by 1%. But as I've written in prior notes, when you're in a significant bear market bottom, and I've measured and studied everyone back to 1950 using this model, what you really need is you just need to see the short-term and medium-term time frames inflect trend and show positive momentum. And off of every major bear market bottom since the 1950s, once you have this, you don't need to wait for the quarterly time frame to follow, because every time you've gotten this, the quarterly time frame has followed eventually. And so it's been a little bit shaky. That sell-off from July to October really tested that thesis, but here we go once again. We've stabilized. back across the range, very strong momentum here. And we've seen enough strong momentum and trend change here to suggest to us that in time this will inflect. So we don't have to wait for the long-term quarterly time frame to inflect. It's good enough that these two have, and we feel that this will follow in time. When you look at the largest bucket across time frames and across percentage of stocks and percentage of market cap, big improvement here as well. This has gone from 25% downtrends to 30% uptrends. So you can see the improvement. This is exactly what the beginnings of bull markets look like. All of this translating into the risk gauge. Again, significant improvement. We now have the monthly time frame of the risk gauge is at 5, so not in risk on yet, but remember this is a fractal trend analysis process. So this can't get better until this gets better, and this can't get better until this gets better. This is as good as it gets. Big improvement from here. This is what you want. The stronger, the better. This is really overbought momentum down here in terms of percentages of stocks above their moving averages, but that's what you want. It's like when you want to launch a rocket into space, you don't do it with a little bit of fuel. In order to get out of the atmosphere and achieve escape velocity, you need a lot of fuel. And so the more momentum at the beginning of a new bull market, the better. And literally, the more overbought, the better. And so we have got a pretty good overbought condition here, and we now have half the market showing a rising 200-day moving average. So these are the boxes that need to be checked in our mind to get a bull market going. And from what we can tell from our bottom up, one stock at a time, 2,600 stocks, trend analysis, we've seen enough to suggest that the lows are in. So the question is, of course, like when you think about, okay, it's a 2-year period of chopping wood, exactly how big is that pile of wood relative to other periods in history? And if we go back to take the S&P back to 1928, and we measure the number of times where the market has gone at least 22 months without hitting a 2-year high, it has not happened very often. It's only happened on 10 other occasions. So this would be the 11th occasion. And what we can see is that of those 10 occasions previously, in only 2 occasions did you go materially lower and test the lows again, here in the 1940s. And then here you went to new lows in 2002. On 2 occasions. On 2 other occasions, you had minor sort of back and forth price action, overlapping structure, but nothing really serious on the downside. And then a resumption of what eventually became a bull run. But in the other 6 instances, you had strong bull market moves, and where we're seeing trend inflection and momentum inflection. We're of the mind that this is the type of resolution we're going to see, where you're going to see a full cyclical bull market. Whether it's the beginning of a secular structural bull market, it's yet to be seen, but we don't need to answer that question today to know what we need to do today. We just need cyclical evidence to get bullish. We don't need to know if it's secular or just cyclical to begin. Let's just take this one swing at a time, if you will. So I've mentioned this in the past, but I just really want to highlight it once again, because it's really, I think this is the part that people might struggle with. If we're beginning a new bull market, and you're looking at the S&P 500, you might be thinking, well, we just went through all this negativity and the S&P just ignored it all. And so how can we begin a new bull market when we haven't even really had a bear market, is sort of the take. And so I just want to reiterate once again that if you knew what the laundry list of bearish macro factors were, and you were given your laundry list and your choice of what the market would look like given that macro backdrop, I would imagine you would say something to the effect of, well, the market would be down 30%, and it would be range bound and very choppy, and there'd be a number of retests of the lows back down 30% again. And of course, the year-to-date return would be negative 7.5%. So if this is what you would look for from a bear market, I'd say you got it. I mean, this is a bear market. I mean, we peaked almost 2 years ago, actually 2 years ago. So this is a 2-year bear market. So if you look at it from this perspective, the market is fully engaged with the bear market. So with the negative macro conditions, and so from here, chopped a lot of wood. This is the kind of conditions that with the macro backdrop seemingly quite negative, it's out of this pile of wood where you light the spark and I should say spark the fire, where in the moment the trend starts, it's not terribly clear from a macro perspective why this bull market is starting. And to be quite frank, that's my most preferred way to start a bull market. When you just don't understand why it's happening, that's the best start to a bull market, because those are the bull markets that have the longest life, if you will. So contrast this, what's clearly a bear market, and what anybody would define as a bear market. I think this pretty much you can check the boxes here, but contrast this with what we know to be taking place on the surface. So this yellow line here is the S&P 500 since the beginning of 2023. This is the Magnificent Seven, which of course is Microsoft, Apple, Amazon, Google, Meta, NVIDIA, and Tesla. And if you just look at those 7 stocks, this is what they've done. And as a consequence of those 7 stocks being a very large percentage of the S&P 500, you can see that the S&P appears to be in a bull market. When you strip those 7 stocks out of the S&P 500, you get this red line. So this is the other 493 companies. And just prior to this rally that we've just seen that's taken the market back across the range, just prior to that, even the S&P 500 with the cap-weighted S&P 500 without the Magnificent Seven, even that index was negative year to date. So again, if you're looking for evidence of a bear market because the macro is so negative, and you kind of need evidence of a bear market to say, okay, we've had our bear market, let's have a bull market. If you're looking for that evidence, it's here. It's just that this particular situation, which is in many regards is the most extreme in history, this has really kind of painted over what is clearly a very strong bear market by any stretch or by any measure. So I think we've had the bear market and we can move on to a bull market. That's my take. So I want to also point out that leadership remains cyclical. This has been something that has kept me from really embracing a bearish view since October of last year, simply because if you believe that the market's the best fundamental analyst on the planet, the best macro strategist on the planet, and it does a good job of absorbing information and assessing what it sees into the future and letting that viewpoint or perspective be shown in things like trend and relative performance and what sectors are leading. If you believe that to be true philosophically, then you know the only view you can take when you look at this leadership in the market is that the market likes what it sees. I mean, this is still remains a very cyclical leadership in what's really kind of kept this bull market from really getting going, despite the cyclical leadership, is we've just lacked trend until now. And you can see across the board in almost every case, we have very strong trends, particularly amongst the strongest of the strong, and certainly within the market cap. So I think finally the ducks are aligned. We have what we need for a bull market. And I think as 2024 moves forward, we'll begin to see evidence, more and more evidence of that pile of wood catching fire. So industrials has been our most favorite cyclical sector since even before the October bottom of last year. And it remains, you can see how it's been very strong over the long term, medium term, and short term here. So it remains one of our favorite sectors. And if you look at the sector, equally weighted. So this is the industrial sector equally weighted, and then this is the sector equally weighted sector relative to the equally weighted market. One of the things that sort of really garnered our attention in the very early stages of the bear market was that as the bear market got started, the relative performance of industrials bottomed, which is extremely uncharacteristic. In fact, it usually leads and participates in bear markets, and you can see here as the industrials continued higher, they began to underperform the market, leading into the bear market. So here we have a bear market finally getting started, and the industrial relative performance actually bottomed into what ended up being a very strong cyclical bear market. So we immediately took note of that, and the way we always process that is that means that when the market settles down and the next bull market begins, this will be, among, of course, other things, this will be part of the leadership. And it's been leading ever since. And more recently, as even post the banking crisis and with the worst bond bear market in history, the industrial sector has broken out to new highs. And after a pullback with the rest of the market, it's kind of resumed its trend and off to new highs again. So this is what leadership looks like. It bottomed from a relative perspective during the bear market. It's breaking out to new highs before everything else. And when you look at the sector from the bottom up in our trend work, we can see that the momentum is very extreme, 90%, 89% positive momentum. 92% of this sector is showing a positive trend on the weekly chart, 60 and 69% on the monthly and quarterly chart. And the biggest bucket is almost half, if not more, 80% in this case here. Almost half of the industrial sector is in a clear new high setting uptrend in the quarterly, fundamentally driven, by the way. I want to reiterate that, fundamentally driven quarterly and monthly timeframes. And of course, the risk gauge is risk on in the short term, and it's risk on in that long-term time frame. So the monthly is again, this is all fractal, so it's like the way Charles Dow talked about how the different movements of water can be at times moving against each other. So you can have the tide coming in while waves are going out. This is here, you see the tide coming in while the waves are going out. This is just the way that the fractal nature of trend evolution and our take when you look at all of this is that this will be up in risk on as well. This is what you need from leadership. Leadership, the only way you get the whole market to get into risk on is that leadership needs to get there first. And we're seeing evidence of that here for sure. So this is what bull markets look like to begin with. Cyclical leadership. The cyclical leadership looks fantastic, and so we don't see any reason to not think that the bull market won't get going into the new year. Okay, and as promised in my charting, my interruption from earlier in the day, I was going through a bunch of charts and I noticed something really intriguing about the Disney chart. No, it's not this. We of course know this to be the case. Disney has suffered tremendously over the past couple of years under the weight of some pretty poorly rated or poorly received movies and some other political and social pushback that they received. So as a consequence of that, the stock over time has dropped 61%. So as always, looking at these long-term winning stocks with presumably still strong quality, whenever you have a stock that's down this much, that has this storied history of outperforming the market, you really should take a look at it. So that's what I did. And this is what I came up with. So the bulls, of course, were dopey to buy the stock in 2021. And of course, they've been grumpy ever since. You see where I'm going with this. So when you take a look at the chart all the way back to 1962, here's what we see. On several occasions throughout this history, the stock has become very oversold. So the recent oversold condition got as oversold as a handful of other times in history. So it does not get this oversold in its history. This is an extreme oversold condition. And this measure here is just the 12-month or the 1-year rate of change. So the stock was down roughly 50% on a close-to-close basis. And you can see that this is a rarity. This does not happen very often. And when you step back and look at all those other oversold conditions, you get this intersecting trend line, and we happen to be sitting right on it. And when you get a 60% drop in virtually any stock, of course, the sentiment turns quite negative, and you begin to see a lot of social media posts and magazine covers and everything else that really deride the management, deride the company, and things like that. And so I thought this one was pretty hilarious. I saw this on social media, but Disney was awarded a defense contract after producing more bombs than Lockheed Martin. I mean, I think that's pretty hilarious. But again, that's the kind of sentiment that you see at extremes in a stock. And then, of course, if you haven't seen this yet, South Park on October 27th had a special called Joining the Pandaverse. And they really take Disney to task on the past couple of years, frankly, talking about their social stances in the movies, and the stances they've taken in the movies, and the changes they've made to characters and everything else. The whole episode is not about that, but the episode is hilarious, as so many of these are. I highly recommend it. But the bigger picture takeaway is that here is a significant negative sentiment making its way into the storyline of a cartoon, right? So when things are so well understood in society that the negativity makes its way into the storyline of a popular cartoon, you know that it's very well understood socially that the company's having challenges. And so it's probably, by the time it gets into a South Park episode, it's probably near the bottom. So the way I would think about it is, don't be bashful. This is where the stock should bottom. Now, it might be sleepy and a little sneezy for a while. As we can see, after these big declines, it can take a period to stabilize and before it resumes its trend. So we may have a bit of back and forth, but Doc says you'll be happy longer term. So that's what I have for you on Disney. I do think it might take a little while for it to stabilize and really truly become leadership, but I think the lows should be in here. So if this is your type of stock trying to buy quality, well-established long-term winners when they're on sale with really super negative sentiment, this is I think is a great time and place to take a look at Disney. Okay, so in conclusion, after chopping wood for 2 years, the wood pile is slowly catching fire and could be completely ablaze in 2024. The degree of trend change and positive momentum that we've seen since October distinguishes it from what we saw in the summer rally, so we would consider this to be a good overbought condition. And what that means is that weakness should be contained. We shouldn't get or decline all the way back across the range again because the trends have inflected. So weakness from here should be bought, and you should be really focusing on buying setbacks in leadership. As indicated, cyclical exposure still rules the day, so still favoring industrials overall, but tech, consumer, financials, and materials are strong as well. And then lastly, while it may take some time before Snow White wakens from her slumber, Disney's stock looks to have bottomed here. Okay, so that's what I've got for you for this month. Thank you so much for tuning in, and happy holidays. We'll speak to you again in 2024. Thanks so much.